Good evening. We're interrupting regular programming with breaking developments in global financial markets that could fundamentally alter the landscape of international banking and precious metals markets within the next 72 hours. What occurred overnight represents not just a technical malfunction in the financial system, but potentially the first visible crack in the foundation of transatlantic banking cooperation that has underpinned global dollar liquidity for decades. Overnight, multiple sources within the European banking sector are reporting that access to dollar liquidity through traditional Federal Reserve swap lines and interbank lending facilities has been effectively frozen or severely restricted. This is not an official announcement. There has been no press release from the Federal Reserve, no statement from the European Central Bank, no emergency press conference. But the evidence is unmistakable in the data. European banks are suddenly unable to access dollar funding under the same terms that existed just 48 hours ago. To understand why this matters, we need to briefly explain how international banking actually functions. Major European banks, institutions like Deutsche Bank, BNP Paribas, Credit Suisse, and others, conduct enormous volumes of business denominated in US dollars despite being based in Europe. They make dollar loans, hold dollar assets, and have dollar-denominated liabilities. But they're European banks, so they don't have natural access to dollar deposits the way American banks do. To bridge this gap, the global banking system relies on several mechanisms. The most important is the Federal Reserve's dollar swap lines with foreign central banks. Under this arrangement, the European Central Bank can essentially borrow dollars from the Federal Reserve and then lend them to European commercial banks that need dollar funding. It's a backstop, a safety valve that ensures dollar liquidity flows smoothly across borders. The second mechanism is the interbank lending market, banks lending to each other directly, often overnight, to manage their short-term funding needs. This market operates on trust. When Bank A lends to Bank B overnight, they're trusting that Bank B will still be solvent tomorrow morning. The interest rate charged reflects the level of trust and perceived risk. What appears to have happened overnight is a sudden dramatic breakdown in both mechanisms simultaneously. European banks are reporting that their access to Fed swap line dollars has been quietly restricted. Not officially cut off, that would trigger immediate panic, but the terms have apparently changed. The amounts available are smaller, the conditions are stricter, the approval process is slower. At the same time, interbank lending between US and European banks has virtually frozen. US banks are refusing to lend dollars to European counterparties or demanding collateral and interest rates that make the borrowing prohibitively expensive. European banks are similarly refusing to accept dollars from US counterparties except under extremely stringent conditions. This is what market participants call a loss of trust event. It signals that major financial institutions no longer have confidence in each other's balance sheets. They don't trust that the other party will be able to repay. They don't trust the value of collateral being offered. They don't trust that the other institution will even exist in its current form 24 hours from now. We've seen this before. This exact pattern preceded the collapse of Lehman Brothers in 2008. In the weeks before Lehman failed, other banks stopped lending to them. Counterparties demanded extra collateral. Funding costs spiked. By the time Lehman actually declared bankruptcy, it had been effectively shut out of funding markets for days. The critical question is, what's on these banks' balance sheets that has triggered this sudden loss of confidence? What exposure, what risk, what hidden liability has suddenly become too dangerous for counterparties to accept? Our sources point to several possibilities. First, there's ongoing concern about European banks' exposure to commercial real estate, particularly in the United States. Office buildings in major cities are worth a fraction of their pre-pandemic values. Banks that finance these properties are sitting on massive unrealized losses. As long as they don't have to mark those loans to market, the losses remain hidden. But if funding pressures force asset sales, those losses become real very quickly. Second, there's the derivatives book. Major international banks have trillions of dollars in notional derivatives exposure, interest rate swaps, currency swaps, credit default swaps, and exotic structured products. Most of this exposure theoretically nets out, but in a crisis, theoretical netting arrangements break down, counterparties fail, collateral becomes illiquid. What looked like a hedged position suddenly becomes a massive directional bet that's moving against you. Third, and perhaps most importantly, there are quiet concerns about the dollar deposits themselves. European banks hold billions in dollar deposits and dollar-denominated bonds. These are supposed to be safe, liquid assets. But if there's a crisis of confidence in US banking stability, those assets become suspect. Will the deposits actually be there when you need them? Will the bonds maintain their value? Can you actually liquidate these positions in size without moving the market against yourself? This brings us to what's happening right now, in real time, behind closed doors at major financial institutions across Europe and the United States. According to multiple sources with direct knowledge of these operations, European banks are quietly, urgently converting dollar reserves into physical gold and silver held in Zurich and London vaults. This is not routine portfolio rebalancing. This is not a modest allocation shift based on updated risk models. This is emergency action, converting digital dollar claims into physical metal as quickly as logistics will allow. The instructions going out to bullion dealers are simple. Buy gold, buy silver, take delivery, move it to allocated storage in Switzerland and the United Kingdom where it's outside the reach of potential U.S. capital controls or banking restrictions. The logic is straightforward. If you're a European bank and you're concerned that U.S. banks might fail, or that the dollar itself might face a crisis, you want to exit dollar exposure. But you can't just sell dollars for euros or yen, that would be too obvious, would move currency markets dramatically, and would trigger the very panic you're trying to protect against. Instead, you convert dollars into hard assets that hold value independent of any single currency or banking system. Gold and silver, held in physical form in secure vaults, become the ultimate safe haven. But here's where the story gets even more significant. It's not just European banks making this move. U.S. banks themselves, seeing the same warning signs that European banks are seeing, are also accumulating physical precious metals. They're doing it quietly through third-party dealers and off-exchange transactions, but the activity is unmistakable. Major U.S. financial institutions are hoarding physical gold and silver to backstop their own positions and to have hard assets available if their paper-based derivatives and collateral arrangements begin to fail. Think about what this means. When banks, the institutions that create and manage the currency, that are supposed to have complete confidence in the fiat money system, when those institutions start converting their own reserves into physical metal, they're sending an unambiguous signal. They don't trust their own system anymore. They're preparing for a scenario where digital claims and paper contracts become worthless, and only physical possession matters. This institutional flight from digital dollar claims to physical metal is creating an immediate, extraordinary demand shock in precious metals markets. And this is where silver enters the picture in a dramatic way. The global silver market is relatively small compared to other financial markets. Annual mine production is approximately 800 million ounces. Total above-ground stocks that could potentially be available for sale might be 2 to 3 billion ounces, though much of that is held in forms that won't come to market at any reasonable price: jewelry, silverware, industrial products, and long-term investment holdings. The paper silver market, futures contracts, ETF shares, unallocated bank accounts, and derivatives claims to represent vastly more silver than physically exists in available form. We've discussed the estimates of 100.1 or even 500.1 paper claims for every ounce of physical metal. The system functions only because delivery requests remain modest and predictable. Now introduce a new category of buyer, major banks demanding immediate physical delivery of significant quantities to backstop their balance sheets. These aren't retail investors buying a few hundred ounces. These aren't industrial users with predictable, scheduled needs. These are institutions with billions of dollars in buying power, urgent timeline requirements, and absolutely no interest in paper substitutes. When a major European bank instructs a bullion dealer to acquire 5 million ounces of physical silver within 48 hours, that's not a request that can be filled from normal market inventory. When 3 or 4 banks make similar requests simultaneously, you have a supply crisis. When U.S. banks are making similar purchases at the same time, competing for the same limited physical inventory, the situation becomes critical. The mechanics of what happens next are straightforward but dramatic. Bullion dealers receiving these orders immediately hit the wholesale market, calling refineries, checking vault inventories, reaching out to other dealers who might have stock. They discover that physical silver in size is simply not available at current prices. The offers they receive are dramatically higher than spot price. The premiums, the markup over the official spot price for immediate physical delivery, start spiking. Simultaneously, these dealers need to hedge their exposure, so they buy silver futures contracts on the COMEX. This buying pressure pushes futures prices higher. Arbitrage traders see the widening gap between futures prices and physical premiums and try to capitalize, buying futures and demanding delivery. Now, the COMEX faces an unexpected surge in delivery demands. Remember, COMEX registered silver inventory, metal actually available for delivery, is estimated at 50 to 80 million ounces after accounting for existing commitments. If just 5 major banks each demand 10 million ounces, that's the entire available inventory. If 10 banks demand 5 million ounces each, same result. We're not talking about a squeeze that develops over months. We're talking about a buying surge that could deplete available inventory within days. As delivery requests overwhelm available supply, several things happen in rapid sequence. First, delivery delays begin. Contracts that are supposed to settle with metal delivery in 2 or 3 days start getting notices that delivery will take 2 or 3 weeks or longer. Some contracts are offered cash settlement instead of physical delivery. The exchange offers to pay you the cash value rather than delivering actual metal. Second, premiums explode. Physical silver dealers who might normally charge $2 to $3 per ounce over spot suddenly charge $10, then $20, then $50 over spot. At some point, the premium becomes so large that the concept of spot price becomes meaningless. The price that matters is the price of actual metal, not the paper price on a screen. Third, the paper market begins to disconnect from physical reality. The COMEX price might show silver at $32 per ounce, but you cannot actually buy physical silver at that price in any meaningful quantity. The real price, the price at which physical metal changes hands, could be $60, $80, or $100 per ounce. The official price becomes a fiction. As this disconnect becomes obvious to market participants, the scramble intensifies. Investors who hold paper silver positions, ETF shares, futures contracts, unallocated accounts, suddenly realize these positions might not be convertible to physical metal. They demand delivery or redemption, adding to the pressure. Industrial users who need silver for manufacturing realize they might not be able to obtain supply and start buying forward aggressively, hoarding inventory. The feedback loop accelerates. Our analysis, based on conversations with bullion dealers, bank sources, and market structure experts, suggests that if major banks are indeed conducting large-scale emergency purchases of physical silver right now, the timeline to a full-scale supply crisis could be as short as 72 hours. Not 72 days, not 72 weeks, 72 hours. Within 24 hours, physical premiums spike to unprecedented levels, and smaller dealers start reporting they're completely out of stock. Within 48 hours, major dealers acknowledge severe supply constraints and delivery delays. Within 72 hours, the COMEX faces delivery demands it cannot meet, industrial users panic about supply, and the price of physical silver in spot transactions reaches $100 per ounce or higher. This is not speculation about what might happen in some distant future scenario. This is analysis of what happens when institutional demand hits a market with limited physical supply and a massive overhang of paper claims. The math is simple and brutal. Let's discuss why $100 silver becomes a technical inevitability in this scenario. It's not about fundamental supply and demand in the traditional sense, not about jewelry demand or solar panel production or investment buying by retail customers. It's about a much simpler dynamic. When large institutions need physical metal immediately and there isn't enough to go around, price rises until enough supply materializes or enough demand is destroyed. At $30 per ounce, the total value of global annual silver production is about $24 billion. That's less than the assets of a single major bank. If just one institution decided to convert 1% of its balance sheet into physical silver, it could theoretically absorb multiple years of global production. When several institutions try to do this simultaneously, there's simply no price level at which supply can meet demand in the short term. The only mechanism that can balance the market is price rationing. Price rises until either new supply emerges from recycling, from industrial stockpiles being liquidated, from long-term investors deciding to sell, or until demand is reduced because some buyers decide the price is too high and exit the market. But here's the critical point. The banks buying for emergency balance sheet protection are the least price-sensitive buyers imaginable. If you're a European bank worried that the entire dollar-based financial system might be entering a crisis, and you need hard assets to backstop your positions, you're not going to quibble about whether silver is $30 or $50 or $100 per ounce. You're going to buy what you need at whatever price is required. Price sensitivity comes from discretionary buyers, investors, speculators, retail customers. Institutional buyers under crisis conditions have no price sensitivity at all. This creates a peculiar and explosive market dynamic. The traditional price discovery mechanism breaks down because the marginal buyer will pay any price and the marginal supplier isn't responsive to short-term price signals. Silver mines can't increase production overnight. Recycling operations can't scale up in days. Industrial stockpiles are limited. The supply curve becomes nearly vertical. Supply is what it is, regardless of price. Meanwhile, demand from banks needing immediate physical delivery is also nearly vertical. They need what they need regardless of price. When you have a vertical supply curve intersecting a vertical demand curve, price becomes essentially arbitrary, determined by whoever blinks first. And banks backed by central bank credit facilities don't blink easily. Technical analysts looking at silver market structure suggest that once physical premiums exceed 50% of spot price, once the disconnect between paper and physical becomes that large, the entire paper market structure becomes unstable.